Hey guys, Dave Keller here with Market Misbehavior. Today I'm going to share with you a tale of three markets. So how has the equity market been doing in 2023? Really good, okay, or not so good? All three of those answers are actually correct because it depends on what exactly you're looking at. If you're looking at mega cap growth stocks, you probably have one take. If you're looking at speculative technology, emerging technology, or a lot of average consumer discretionary stocks, you're probably having a very different point of view about what 2023 has been. This is why I would describe this as a tale of three markets. Before we get to the charts that tell this story in a little more detail, if you like this sort of thinking about investor psychology, technical analysis, behavioral finance, and market history, go ahead and subscribe to my channel. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below. Do you think the S&P goes higher than 4,200 or finds resistance at 4,200, and why? Let me know in the comments. So we're looking at my chart of the S&P 500 to start with, and what I wanted to focus in on was where we're at today, because it's pretty much exactly where we were in February of 2023. I want to key in on that point because if you think about the October low from last year, we sort of had this rally phase in the fourth quarter, brief pullback in December to 3,800. Then we made a new swing high, and that was meaningful because it pushed us above a trend line using the 2022 highs. So when we made a new swing high here to 4,200 in February, we pulled back, retested 3,800 again, and this sort of set us up for the range that the S&P has been in for the last 6 months or so. Because over the last 6 to 8 weeks, we'll call it, we rallied back up toward 4,200, and now, starting in late April, in mid-May, and now again in late May, we keep testing 4,200, but we're struggling to power through. So we're doing that sort of classic issue where we trade up to resistance, but not through resistance, and that makes a big difference on the charts. So while the S&P 500 is flat from February to the end of May, what have other stocks actually been experiencing? And this is the chart I wanted to really show you, which is a tale of three markets. We're starting the clock at that February 2023 peak. If you remember, the S&P 500 was about flat, and as of this moment, it's up about 0.8%. These little blips right here, if you look at the 0% line, that's basically S&P 4,200. That's the February peak. So you can see we traded up to it in late April. We're now trading above it a little bit, but overall we're essentially flat for this 3-month period, February, March, April, May. That's 4 months as I'm counting them as I'm saying those words. Over that same 4-month period, though, the Nasdaq 100 is up over 12%. Now, again, the Nasdaq 100 is still very geared toward those mega cap communication services, technology, and consumer discretionary names. But overall, over that same time period, while the S&P is flat, the Nasdaq 100 is outperformed by about 1,100 basis points, even more than that, and it's up over 12% over that period. Look at the equal-weighted S&P. This is an ETF called RSP, and it basically recreates an equal-weighted version of the S&P. The problem with the Nasdaq 100 and the S&P 500 is they're very heavily weighted toward the biggest names. As a matter of fact, in the S&P right now, the top 10 stocks, like Apple, Microsoft, Amazon, and those types of names, those top 10 stocks are about the same weight as the bottom 400 stocks in the S&P 500. That's how dominant those mega cap names are in the calculation of an index like the S&P 500. So the S&P is flat because the biggest names, the Nasdaq 100 types of names, have been doing particularly well, and it's the largest of the Nasdaq 100 that are really driving that. The average stock is actually struggling in 2023. The equal weight S&P is down 9.3% off of the February high. So remember that chart of the S&P 500 testing resistance at 4,200. During the same period, the Nasdaq 100 is kind of up here, and the equal-weighted S&P is actually down here. This is the essence of a tale of three markets, is it depends on what area of the equity market you're looking at. Now, two individual stocks we can look at that sort of fill in this detail a little more clearly. This is a chart of Etsy. Look at what Etsy looked like in early February. And this is sort of that February peak that we were looking at on the chart of the S&P 500. Now, Etsy bottomed out a little bit earlier. While the S&P made a new low in October, Etsy actually bottomed out in the late spring, early summer, and from there started to rally. Pulled back in October into November, but made a higher low there. And then made a new swing high in December and another new swing high in February. So in early February, Etsy's actually making a new swing high, a new high for the year, and really starting to look as if it's going to the moon, or at the very least retesting those highs from the end of 2021. Look at how much that's changed from early February to where we're at today. So while the S&P is back up here testing 4,200, and 150 is about that same level for Etsy where it was at the February peak. Now we're down at 81, so we've about halved the stock. We're down about 40 to 50%, while the S&P is essentially flat for that period. Now, here's the other thing, right? While other stocks are doing just fine, right? The chart of Apple and Microsoft looking very differently and much, much stronger. Semiconductors have been thought of as one of the leading parts of the market with good justification. I would say NVIDIA, AMD, these are all stocks that have been gapping higher, going vertical, accelerating to the upside. Pretty much all of those semiconductor names, for the most part, overbought at the moment, but have had a pretty exceptional 2023, and really this flood of assets and attention into the AI trade has really propelled semiconductors to new heights over this period. Here's a potential concern, though, as the S&P is testing 4,200 and testing significant resistance. Above there, by the way, you have 4,300, the August high, which is also a Fibonacci level, which we've covered elsewhere in other videos on our channel. The SMH, which is the semiconductor ETF, is testing all-time highs. Here's the sell. This is a weekly chart of the SMH going back to 2016. You can see the run fairly consistently into the peak at the end of 2021. 2022, of course, a very different year. Semiconductors bottomed out in October of last year, just like the S&P 500 did as well. From there, we've had this beautiful rally phase off of the October lows to where we're at today. But look at how close we are to those all-time highs from the end of 2021. The concern for charts like Apple is that they've had an incredible rally, but now they're testing significant resistance. The concern for semiconductors, I would argue, is the same thing. Those leadership names that have been driving things higher are testing those key resistance levels. Not just key resistance levels, but like the ultimate resistance, the all-time highs that arguably could and most likely will provide at least some sort of significant resistance here going forward. So the bull case from here is that semiconductors and other areas of the market that have been strong continue to be strong. We don't just trade to resistance, but through resistance. SMH gets above their 2021 highs. Apple propels to a new all-time high. This market continues to look very strong. And I would argue, even despite weakness elsewhere, we're probably going to see those other stocks start to really get dragged higher if we see further upside. However, there's a bear case which is starting to look a little more clear, and it's this tale of three markets. The weight of the average S&P stock doing so poorly really prevents the optimism that has taken hold of these semiconductor stocks and other growth stocks to propel the market much further. Right now, the S&P, the S&P 500 has been essentially flat, given this dispersion of returns from the winners to the losers. If there's enough weakness there and enough profit taking in some of those leading names, everything can kind of get dragged down. The good news is, regardless of whatever happens, the charts are going to help you navigate that period. They will tell you when those leading stocks are starting to struggle. They will tell you when beaten down areas of the market, like energy and financials, are really starting to work. So now more than ever, I would pay attention to the trends and pay attention to the charts. For Market Misbehavior, I'm Dave Keller. Be well, stay safe, and I'll talk to you again soon.